Welcome to another edition of the Best Business Minds, where we interview business leaders and academics that write thought-provoking books. I'm Marc Kramer, a serial entrepreneur who consults with family businesses and entrepreneurs. Today's guest is Matt Blumberg, co-author of Startup CXO. Matt, welcome.
Thanks, Mark. Great to be here.
I like the t-shirt. I gotta get one of those.
I am always on brand. Our business is, which I'm sure we'll ask about at some point here, but our business is a very personal human business, and I spend all day on Zoom and all day talking to someone that's a stakeholder for us. So I decided at the beginning it would be it's easy, especially working from home, as we're all doing for the most part still, to just buy 5 bolster t-shirts and make that my my easy to choose outfit in the morning.
I think I should have a Best Business Minds t-shirt. I think you're right about that. I need to think more about that at all times, for sure. Okay, so let's first start off with your background. Give us a little bit about your background.
Yeah, so real quickly, the rundown from college, so my whole working experience. I did a couple years in management consulting, a couple years in venture capital, and then in early 1995, I was hired by a small cap public company that was a sort of a tech media interactive services company before there was really an internet, called Moviefone, that was in the business of doing these branded centralized telephone numbers.
Yeah,
I might remember, like 777 film.
Yeah.
So it was a pre-internet interactive services company, and they basically hired me to figure out what the internet was for them and what it meant and what they should do. And I ended up being the GM of their internet business from 95, 6, 7, 8, 9. So I wasn't the founder, but I was of the company, but I was on the executive team, kind of founded the internet business. We sold the company in 99 to AOL at kind of the peak of the .com one era. I then started a company in 99 called Return Path, which was in the email marketing space, ran it and scaled it over the course of 20 years, sold it in 2019. And then, and that business got to be decent scale for a startup. It was about 100 million in revenue and about 500 employees and global, and very good brand in the email business. And then a team from Return Path and I started Bolster together in 2020. And I've been on a lot of experience on boards. I've been on a bunch of different boards over the years, public, private, nonprofit. We started a nonprofit at Return Path, sort of incubated it at Return Path, and then spun it out into an independent nonprofit called Path Forward back in 2016 that helps moms get back to work after a career break. So it's a structured returnship or return to work program that I still chair today as well.
Oh, I need to connect you with a woman who has started a program to connect moms who are stay-at-home moms but still want to be involved in the workspace. So you might be able to be a good advisory board member for her, or at least give her some good insights. So that'd be great. So let's talk about the book. Why did you co-author this book?
So I wrote a book. I've written a blog for a long time, like since 2003 or 2004 now, that's called startupceo.com, about really the journey of being an entrepreneur. I turned that into a book called Startup CEO, which was published first in 2013 and is really meant to be like a instruction manual. If you've never been a CEO before, if you're if you're a founder, first time CEO, it's like 60 chapters of how to do XYZ, really short, practical, tactical advice. And I had in my head when I wrote it, this sequel, which I didn't get together until last year, which is called Startup CXO. And CXO, not everyone kind of understands what that means. It basically means chief anything officer, like chief fill in the blank officer. So it's a shorthand for, for executive of any kind. So Startup CXO is a sequel in that it is also an instruction manual, but it's kind of a book of books. So it's an instruction manual for everyone on the executive team. There are 20 chapters about how to be a CFO of a startup, 20 chapters about how to be head of sales at a startup, head of HR, head of business development, head of engineering, head of product, et cetera. There are like 8 or 9 sections. And within each section, it's really meant to be an instruction manual for the person who's doing that job for the first time. Lots of startups have people that are doing that CXO job for the first time.
Yeah.
It's also meant to be kind of a startup, an instruction manual for a CEO in how to think about managing that function, how to hire for it, what you're looking for, what the person needs to be doing, how you need to hold them accountable. And then I would say it's also a little bit of a guide for colleagues of how to engage with that function, right? So the head of sales should read the sales section, but should also really read the marketing section and read the finance section, read the product section, so they understand the world of the people around them. And then finally, it's I think a good guide for people early in their career who are trying to figure out what their next step is. So, if you're a sales rep and you're interested in sales management and sales leadership someday, getting your arms around everything in the sales department and where you need to learn and build skills and grow in order to advance your career in that department is, the book's kind of a roadmap for that as well.
Well, that's what I liked about the book, and especially what you just mentioned, where understanding all the other functions, because I think many times, sales doesn't understand IT, that doesn't understand research and development, and therefore think, why are we giving these guys so much money or space or whatever that is? Because they really don't understand how all the parts fit together. And you're right about kids understanding where they want to go and where they're going to fit in for their careers. This book is great for that as well. So let's talk about this. Your first startup was Return Path, correct?
Correct.
Yeah. And what did you learn from that experience that changed, that surprised you and encouraged you to go and continue being an entrepreneur with Bolster? And also kind of explain the mission of that company as well.
Yeah, it is actually related. I mean, the Return Path journey was long. It was 20 years. And one of my theses on the way into that business, and one of the reasons I wanted to become an entrepreneur in the first place, was that you have to wind the clock back a little bit in your mind to 1999. The business world was not employee centric in 1999, and you could argue that it's still not employee centric today. But I had worked at these different jobs earlier in my career that were all knowledge worker jobs, right? Consulting, venture capital, interactive services company, right? They all had, people were literally the most important thing in the business, and they all had that on the wall somewhere, right? Our people are our most important assets. Our assets walk out the building at 5 o'clock every day. Some flavor of that as like a value, but I never felt like any of those organizations really got that and internalized that. And, I felt like in a lot of ways, they still treated their employees the way you would treat employees like on the factory floor in the 1800s. So part of the thing that I wanted to achieve in starting a business was really building a different kind of workplace, and a workplace that valued its people and really invested in its people and made that a competitive advantage. And that was a big learning over the 20 years of Return Path, that at every turn, when we made decisions that involved people, if it was just top of mind for us to be people first, to think about employee engagement, to think about the impact of decisions on people, to help people grow and build their careers. And that type of culture and philosophy really did wonders for that business. And the second part of your question is interesting because it is very related to the business at Bolster. My co-founders and I all worked at Return Path for many years, so we knew marketing technology cold and could have easily started a new business in MarTech, and didn't want to. What we wanted to do was start a business to help other startups advance their leadership teams and advance their cultures and advance their boards. And that's really what Bolster is. So Bolster is an online marketplace. It's a marketplace for executive talent, and it's a marketplace to connect that talent to startups and scale-ups. So our mission is really to help empower founders and advance the startup economy. We work with teeny tiny startups, and we work with $100 million companies that are probably not startups anymore, but were startups. We work to really help them scale their leadership teams and scale their cultures and scale themselves as leaders and scale their boards. So very related to the experience at ReturnPath.
As I read the book and how you mentioned each section of the business has a unique value, is there one area that if you're going to put little resources in at the start of the business, what would that be?
You know, my answer is going to be HR. And it's not the obvious thing. Product is obvious, right? You don't have a product, you don't have a business. Whether your investment in HR is in an HR leader or a contractor to do that part-time, like a fractional HR leader, or it's just an investment of your time as the founder or time getting a coach involved, investing in people and a robust people function earlier than you would think, I think is a really smart investment. It's an investment in your talent in the organization.
Many entrepreneurs feel they want to get the least expensive employees, which usually means ones with little experience. What do you think about that as a way to keep costs down and mold people into the culture you're trying to create?
I have kind of mixed thoughts on that. If I'm wearing my Bolster CEO hat, the self-serving answer is, hey, use fractional executives. They're cheap and because they're not full-time and they don't usually get equity, and they give you the experience you need, and use them to help bolster, which is the name of the company, your more junior startup team. But the non-bolster answer is, in the early days, you just have to have a mix. Like you got to have some people that know what they're doing and some people that are early in their career, and that mix changes as you get bigger, but it doesn't necessarily change a lot. I mean, as companies scale, if they're scaling well, they're building a talent engine that's really good at bringing in early stage people and training them up. So whether you're early stage or mid stage or late stage, you have to invest in training and coaching and good management and leadership to go with the people who come in with less experience. And we found at ReturnPath, we had a really good model that was grooved by the end around our sort of leadership level in the business. At the end of the company, we had something like 12 people on the executive team. And I think other than the 3 founders, every single one of them was promoted from within. They were people that we hired in. A couple of them had been at the company forever and started as junior, and we sort of trained them up. But a lot of them we hired in at kind of that director level or VP level or manager level. And then to your point, Mark, we had the opportunity to kind of mold them into the culture, to imprint the culture on them over the course of a few years and grow them into senior people. And that model worked incredibly well for us.
Yeah, I think that makes a lot of sense. I've actually hired people who were super experienced that were horrible in a startup, and I've had students from my own class who were brilliant and really got it quickly and came up with great ideas that help propel the company. When hiring salespeople, should you go with entrepreneurs who work with a name brand company or a different type of person? What do you look for when you're hiring salespeople?
Yeah, it's an interesting topic. I think there's always the lure of like, oh, this person worked at Oracle, right? They know how to sell. And like, maybe is the answer. But it may be that they worked in a selling machine that supported them in ways that you can't support them as an entrepreneur. I think I sort of use this metaphor when I think about the different stages of enterprise selling or sales organizations. And I'll do the shorthand version of it, which is you go from selling on whiteboard to selling on PowerPoint, or I guess Google Slides, to selling on PDF. So selling on whiteboard is what you do as a founder. You literally walk into a prospect and you're drawing shit on the board, excuse me. You're making things up and you're connecting, in that creative moment with the client. That gives way as you get bigger to selling with slides or selling with PowerPoint, where you can have sales reps that you train, but they really need to be like senior business development people who, who know how to take product that's still half baked and turn it into a sales process. And I think the way to think about that, the reason I call it selling on PowerPoint or selling with slides is they approach every sales call like it's a new thing. And they think like, oh, well, let me take that slide from that deck and that slide from that deck and that slide from that deck. And that's what's going to make this one work. And then ultimately stage 3 is selling with PDF. And that's when like you're a sales machine. You have one PDF, maybe you have different ones for different segments, but you have a PDF, you have a call script, you can hire junior salespeople and you hand them that stuff and they go. And when you're a startup hiring salespeople, you need to know which stage you're at and make sure you're hiring the right people for that stage. And if you're at whiteboard trying to move to PowerPoint, or you're squarely in PowerPoint and you've got to live through that for a few years, you can't hire people that have only worked in places where they're selling with PDF. You have to hire people that are capable of doing that almost quasi evangelist founder-like sale.
We have a question from the audience. What do you recommend as founder equity to attract very early stage new talent?
Robert, I want to ask a clarification. Do you mean if you're a founder looking for a co-founder?
No, he means, when you're hiring people,
yeah.
and how much equity do you give them, or how do you go and get top tier talent, and how to use that equity to do it?
There's a lot of stuff that's been written about that, and I think that the quick answer is you have to think about it like you're budgeting equity the way you would build a budget, and think about it in kind of layers. So there are a couple people that are going to be at that top layer that get a lot more than the next layer, and there are many more people at the next layer and even more people at the next layer. So you can use equity. You just have to be smart about how you're balancing out how much experience with how much equity. So like if you're trying to hire a CXO, right, you're trying to hire a leader and you're really early stage, you may be giving them a couple percentage points of the company. If you're just trying to hire a great sales rep, you don't necessarily have to give them a couple percentage points of the company. You're talking about then giving them, 0.2 of a point or 0.3 of a point or something like that. I don't know that there's a magic formula, but I'd encourage you to think about it in layers, basically.
No, I agree with you. I worked for a CEO of a big biotech company. It was a company called Senecor, who said he was running an IT company that worked on biotech healthcare problems. You had a debate at your last company about whether you were sales driven or product driven. How do you determine to know which one you are or want to be?
Yeah, it's I remember that debate. I think I wrote about that in both books actually, and it was I think it's a little more of an academic debate. Like the debate we had at the board level was, are you Apple or are you Oracle? Right? Apple is a product company. They care mostly about their products. Their products, sell themselves. People camp out overnight in line to, be the first one to get the new whatever. And, whereas Oracle is famous for being a sales machine, right? You drop anything into the sales machine and it gets, stuffed through the channel. And I think the reality is for most normal companies, it is a sliding scale. You have to do both well enough to get yourself, working in life. And, being all sales is hard and it's not very satisfying. Like ultimately you want to solve customer problems, and you do that by having good product. The way we resolve that debate, I think, is, as I said, we're a people company. So we're not a product company or a sales company. We're both of those, but because we're a people company.
So how do you get the different leaders fighting for their own budgets? And we talked about this before everybody came on. Not to mention each leader might think they should be the future leader of the company, to see the big picture and work together.
Well, yeah. First thing is, if you have people that are spending all of their time fighting for their own budgets and fighting against each other, you probably have the wrong people. But you might be leading them the wrong way as well. And the concept that I've always gravitated to is what I call the first team concept. And this is one that another business guru and business book writer named Patrick Lencioni has written about quite a bit. His best book about this is called The 5 Dysfunctions of a Leadership Team, which is a fantastic book. The concept of first team is the executive team needs to be the first team of every executive who sits on that team. So if you manage your leadership team like it's the United Nations and each department head comes in as the head of their delegation, then you're managing a team that's fighting. They're fighting for budgets, they're fighting for airtime, they're fighting for primacy. If you manage your executive team as the first team, where first and foremost, the people sitting on it are executives who collaborate together to run the company, you don't end up with those turf wars.
Yeah, and they can rip the company apart. Many of the people on this call are CEOs of entrepreneurial companies, and you talk about 3 steps for new leaders to be effective. What should the CEO screen for, and how should the CEO prepare the future leader to be successful?
I think, and I wrote about this in Startup CXO, that I sort of talked about, I think, three different rules of 3. One is that senior executives or CXOs have 3 roles, right? They're on the executive team, right? That's their first team. They are the head of their department. And then they're also just generally a leader in the company. So you're authorized, I think, as a leader in the company. If you see something, you say something. It doesn't matter if the person reports up to you or not. I also talk in the book about the sort of 3 jobs, very broadly speaking, that CXOs have to do. And those are, number 1, master the details. So understand everything that's going on in your department. Number 2 is form your strategic approach. What is your department's mission? What is your department's ethos? How is your department going to drive the business forward? And then finally, as a CXO, you have to be able to look around the corner and see what's coming next and be planful a year out, 2 years out, 3 years out, both about your department's activities and really your own role and your own skills and your own leadership profile. So, when it comes to, sort of how you screen for those things as you're interviewing potential executives to join your team, I think it's really 2 things. You're screening for that framework approach. When I talk about, being able to have a strategic approach to your department, you want to put someone in a leadership job that has a theory of the game, right? What is their department going to be all about? How does their department fit into the company? What's that framework? And then, screening for the ability to see around corners, I actually think is easier than it sounds. So if you're a Series B company and you're hiring a head of marketing, you know what the job is today. Ask them in the interview process what the job is going to be like in 2 years and see what you get back. And one of 3 things will happen. They either won't know and will fumble around the answer, in which case you don't hire them. They will know because they've seen it before. And they'll say, well, now we need to focus on X, Y, Z. In 2 years, we're going to need to focus on PDQ. Or if they don't really know what's around the corner, at least what you're looking for is a thoughtful response of like, I know what today's world is. And here's what I will do to figure out what the world's going to be like in 2 years. Because I don't know, and you don't know either, but here's together the journey we're going to take to get there.
I wondered, you were a venture capitalist at one point. Do you think you'd be a much better VC now that you've run companies? Because so many VCs come from investment backgrounds, but don't have actual line operating experience. You think you'd be better at that job now based on your experience of actually running a company?
I don't know. I think I would be a good operating partner somewhere.
But maybe not necessarily evaluating the companies, because I know that when I work with VC funds, the ones who didn't come from entrepreneurial backgrounds said they worried about the entrepreneur would be too soft on the portfolio companies because they would be too empathetic. And the ones who didn't wouldn't have that kind of empathy and just would look at the numbers and be more black and white?
Yeah, I don't know. I mean, I think I don't know that I agree with that point, although I could see how an operator would fall into that. I think the challenge you have as an operator, as a venture capitalist, an operator who moves into that role, and some of them make that transition really effectively, is the "I would do it differently" challenge. And sometimes that doesn't necessarily mean the person's not doing it the right way just because you would do it differently. I like to think I would be good at that. Actually, one of the things we're doing at Bolster is, and this is a little advanced news, I think it's going to come out probably in January, is we're actually standing up a venture fund. So I'm about to be in, to some extent, in the world of both, and we'll see how it goes.
So a question from the audience: what are the
Yeah.
concerns when the members of a startup executives team are not from the products industry, and how do you overcome those concerns?
Yeah, when I think about hiring executives or hiring board members, I sort of look at it with a few different dimensions. Do they have industry experience? Do they have the right functional experience? Do they have the right customer set experience? So, maybe they've been in sales, but they've done enterprise selling and you're selling to SMBs. And then the fourth thing is, do they have the right stage experience? So have they worked at a company at your size and stage and made the transition to the next size and stage? It's rare that you're going to get all four of those things in the same person. You want to get as many as you can. And I'm not sure I favor any one of those over the other ones, as long as you have a balance across your executive team. So you don't want a whole team where no one's got product experience, but you also don't want a whole team where everyone's got product experience, but no one's got the right customer set experience or proper functional experience or stage-based experience. So I reframe the question in that way of thinking you got to balance all those things out.
So another question from the audience: I read a startup's culture is created as soon as you hire your first employee. How important, and I think you write about this in your book, how important is culture to creating and scaling a successful startup and in building a highly functioning CXO team?
It is incredibly important, and your question is framed perfectly. What I always say is your company has a culture from day one, whether or not you acknowledge it. And the more people you hire, the firmer the culture gets, right? It's like Jell-O in the fridge. It may be liquid at one point, but it's not going to be liquid for long. And if you're not intentional about shaping it yourself, it is what it is. But you can be intentional about shaping it yourself, and it is unbelievably important in terms of. And I'll put the question in reverse order. First, it's important in terms of building a high functioning leadership team, and it's important to scaling the company.
Another question from the audience: with hyper growth companies need a strategic framework that has well-defined process and KPIs to create better synergy within organization. What's your take on value management?
I'm not sure what you mean by value management, Vimy. So feel free to jump back into the chat on that. I think if what you're saying is it important to have values? Absolutely, and that's sort of my previous answer about culture. If your question is it important to have KPIs and defined processes with hypergrowth companies, or can you ignore them because you're a hypergrowth company? The answer is you need them. And actually, the faster you're growing, the more you need them, or things kind of spin out of control.
Yeah, and we've seen high growth companies where that exactly happens, and then they end up replacing the founder because of that.
Yeah.
They write here value management in people, product, process, portfolio, performance, and processes.
Again, if the
and profit.
Again, if the answer is about values, like culture and values, those have to permeate everything you do, right? Your values mean everything around people, around what kind of product you build and how you build it, around your business processes. I'm sure I may not be understanding your question exactly, but
and then they wrote here 360 value management. I'm not familiar with that.
I'm not either.
Yeah. So we'll have to look that up and maybe get back to her. You have a section on every function and company, but I thought the chapter written by your CFO was interesting. he writes about being more than a bean counter, all the various things you need to know, ranging from taxes to technology to interacting with investors. What's the profile of a successful CFO of an entrepreneurial company, and what should a leader screen for when selecting one, especially one that you need to think strategically and not just focus on saving money?
Yeah, I think the thing you want to screen for, and that's like front of the profile, is someone who has a philosophy around investment, not around cost. Now, that doesn't mean that you want someone who spends money like a drunken sailor. You want someone who is focused on that, but you want them focused with the lens of investment, right? I will spend an infinite amount of money on X, subject to how much money I have in the bank, as long as there's a good return on it. And I think that philosophy is important. And I think there are lots of CFOs who are probably very good CFOs who come at it more from like a cost or accounting perspective. And I don't find that to be strategic enough for startups. My longtime CFO and sort of two-time co-founder now, Jack, who wrote that section of the book, has this sort of his framework, and his approach to the job is finance as a partner. And how can he or his department, as the company gets bigger, how can he help everyone else in the company make good decisions using data and numbers? And I love that orientation.
I think a lot of entrepreneurs have come across in large companies CFOs who are Dr. Knows about everything. And so in an entrepreneurial environment, you want them to be cautious. I mean, careful with the money, because it's not plentiful like your Microsoft or Amazon or some of the others. But at the same time, you want them to think strategically and be willing to spend money to acquire customers or to build the next iteration and so forth. So I think that's, and your guy clearly does that. Many times when I'm interviewing entrepreneurs raising capital, I ask them what is their gross margin followed by their net margin. And they rarely know the net margin, which I think is more important. How critical do you think it is for the entrepreneur to know what makes this up? Know all the formula here so they're able to answer those questions.
I mean, it's real easy. Cash is king. You're a startup, unless you're a startup that's making money from day one. If you're burning money and you're in the cycle of raising more money, cash is king. And you can look at EBITDA all day long, but EBITDA and capitalizing of expenses, just like it distorts the view of cash you have in the business. And that is the only thing that matters. And your ability to forecast cash in your head is pretty important as a founder, even if you're not a finance-oriented founder.
I agree with that. I mean, I've worked with many companies where we've gone in front of investors and they didn't know their own numbers and they weren't able to explain their own numbers, and nothing drives number-oriented people like investors crazier. Even if you have the greatest idea, even if you have a lot of folks who love this idea, if you can't explain these numbers and have a good firm hold on where your cash is going, that scares the hell out of these investors. And then they feel like maybe as smart as you are, maybe we need to put a babysitter in to watch this. And certainly they worry about whatever numbers you're showing them. Often early stage companies have no idea what their valuation should be. What's your advice on arriving at the right one? Probably not exact valuation, but pretty close. And you talked a little bit about that in the beginning here.
Yeah, I mean, I think there are two approaches to this. One is you go out and you get a bunch of offers and then you see what market is, or you follow the route of doing notes or safes. And I think there's a reason those have gotten so popular for seed rounds and pre-seed rounds now, which is that it's just a lot easier. It defers the conversation till a later date when you can actually have valuation metrics. But ultimately, when you're running a financing process, you just need to get multiple offers to the table, and then you figure out what market is, and whether you like it or not is a different story.
Yeah, we had an entrepreneur. We have the Angel Venture Fair on Tuesday. I run that in Philadelphia with companies from across the country that are participating. And one of the companies decided they're not going to present because an investor had said to them they don't want them to present that they're going to work out a deal with them. And I said, you're putting yourself at a disadvantage by doing that. You want as many people bidding to invest in your company as you can, so you get the best possible deal. And also, once you do that, then you've eliminated the need to get to close a deal quickly. If you have a lot of folks who are interested, deals get closed quickly. If you
That's right.
are working with one, they stretch it out to the point where now they're going to start dictating the terms to you.
And that's especially true today. The combination of how much money there is sort of floating around in the venture ecosystem, with, quite frankly, Zoom and the Zoom culture means you can like spin up around and get it done very, very quickly. Actually, one of the challenges today is that valuations are getting out of control, and it's really easy as a founder entrepreneur to say, like, I'm just going to chase the highest valuation possible. And like, there's logic to that, right? It's the least amount of dilution. Maybe you get the most amount of cash in the door. But these people who are doing seed rounds at $50 or $100 million I think, are setting themselves up for a problem down the road, because those are investors. If you're a seed investor and you do a $100 million valuation deal, like, what's your expectation of the next round when people start paying attention to financial metrics? Like, it's really tough.
Well, what's the real estate one where you go and sit in the nice couches and so forth, and how that valuation got reduced by like 90% because people bid it up so unrealistically high, not based on any real world metrics, right?
Yeah.
So, and you're right in the sense of, you want to get an investor who really understands your business and you feel like you can go to war with them, not just the one who's going to give you the highest valuation, because they're also the ones who are going to beat the crap out of you if you miss your quarterly number.
Absolutely. And look, as someone who has done a down round, let me tell you, that's one of the least fun things you can ever do. It's not as unfun as layoffs, but those are probably the top two.
Yeah, no question about it. It's horrible when you have to go through something like that.
Sorry, I was just going to read the question in the chat.
Oh, no. Yeah. So, do you think solo founders are less attractive to investors? And do you recommend founders should try to get co-founders for improving probability of success, and also to make the company more appealing to investors?
Yes, that is an unequivocal answer. And I don't know what the right formula is. If you're a technical co-founder, make sure you have a business co-founder. If you're a business co-founder, make sure you have a technical co-founder at least. By the way, having co-founders doesn't necessarily mean equal economics, but having people who more than one person who is like a founding partner in the business, I think, is viewed very favorably by early stage investors.
Yeah, I think so. And I think one person should have more equity than the other, because I've seen not work out when they both have the same amount of stock. And let's face it, you wouldn't have heard of Steve Jobs without Steve Wozniak.
Absolutely.
Yeah. So
Paul Allen, Bill Gates and Paul Allen.
Right. Yeah. You have to have John Malone and John Stockton and Carl Malone, right? In the section of selecting legal representation, you mentioned the need for the leader to outline what you need the attorney from the attorney, and getting the attorneys where bills, so the bills don't get crazy, and provide an estimate you can count on. Many leaders pick attorneys from their church, the Rotary Club, the country club. What do you recommend in finding the right attorney?
Yeah, you got to find someone who knows how to do the thing you need done. You're negotiating a financing, for example, against VCs. I shouldn't say against, you're negotiating it and documenting it with VCs. VCs do dozens of financings every year. If you do not have a lawyer that knows how to do a venture financing, you have a problem on your hands. So you really do need to get someone that knows the thing that you're doing. They know what market is for different terms. And if you don't have someone like that, find one. Like, ask the VC who they recommend. Ask other entrepreneurs. Ask seed investors. I think that's really important. I think what's more of a question mark is, like, do you use a big firm or not a big firm? And the question there is, the problem with huge firms is both that the bills are big, but it's also that you don't get a lot of partner attention as an early stage company. You'll get like a third year or fourth year associate working on your deal, and like maybe that's okay if you're doing a really simple, really simple deal, and you think you can at least have a couple hours of partner attention. That's probably okay. We've had a lot of good success over the years working with kind of mid-tier firms. This is true with accountants and auditors as well. Working at tiers, second tier, third tier firms where you get more partner attention, the bills are lower, you still get people that really know what they're doing.
How much of CXO's compensation should be tied to achieving their goals, and how much to their ability to work with the other CXOs? Ask another way, do the ends justify the means, which is a question from our audience.
Yeah, so my formula for this at Return Path, which I think worked really well, was that the incentive compensation was a mix of personal MBOs and team MBOs. And I think some years it was even a mix of like company metrics, executive team MBOs, and then individual. And that's true even for head of sales. Obviously, head of sales has a very large commission plan or override, but still had meaningful components on my team that were tied to team goals and tied to company metrics. So I think if you're doing an incentive comp structure for your executive team, and there's a question of whether those are productive or not in general, which I'll come back to in a second, but if you're doing one, I definitely recommend at least having a few bands of it. So you have different levers to manage, but you're sort of reinforcing that first team concept that we talked about earlier of like, you're not here just to represent the product department, you're here as a member of the company's leadership team. I've increasingly over the years come to the point of view, though, that incentive comp doesn't actually work well most of the time, and that most of the time it is more complicated than it needs to be. That you're administering a program where everyone ends up getting a huge percentage of it anyway, or is extremely disappointed if they don't. And in early stage companies, tying people to revenue numbers when you have no idea what your sales machine looks like and what your pipeline is going to be is a good way of screwing things up. But there's a real question other than salespeople, and I do think salespeople are often motivated by money. There's a real question in my mind of whether incentive compensation makes any difference at all for anyone other than salespeople. We ended up at the end of Return Path actually disbanding our incentive comp program for anyone in the company other than salespeople and sales leaders. Even executives did not have one. And at Bolster, we're still really early stage, but no one has an incentive comp program.
I did that in one of my ventures, and I found out that the people were so focused on bringing in the sales that they had no interest in the customer retention. So I had to change the comp plan that, you couldn't bring in 100 companies and lose 99 of them,
right,
and get this great compensation. You had to go and retain the 99 you bought, or a percentage of them, and it changed based on the percentage.
Absolutely.
But, yeah. So few folks are focused on that.
Yeah. By the way, depending on your structure too, if your head of sales is also the head of customer success and also carries the retention number, then your head of sales will make sure that you're only selling to people that really want to be there.
Yeah, and making sure they follow up. So I had one company, it was in the software space, and they sold a bunch of the product, but no one ever followed up to make sure they were using it. When it came time to renewing the agreement, 50% of them dropped out and they went back to the competitor. It was a nightmare. You wrote that next to the CEO and the heads of sales, the next or equally valued position is the head of marketing. What do you look for in the head of marketing, and how do you measure their success?
I don't know that I exactly phrased it that way. I always am very careful to not value one executive position over the others so much. It really is a team sport. But in any case, with marketing, I always look for someone who first of all, has the right mix of art and science. Marketing is very much one part art and one part science. And what I mean by that is you have to have someone that has good creative sensibilities. but you also have someone that knows, you have to have someone that knows how to manage numbers, and really has that philosophy of investment and return on investment as it relates to marketing. I think one of the one of the things that a lot of CEOs don't get right is making sure they're intentional about the kind of CMO or the kind of head of marketing they're looking for. And I've seen companies be very successful with strategic heads of marketing. I've seen companies be very successful with very tactical heads of marketing. It's just, that's just a question. Are you putting marketing at the nose or at the tail, right? Is marketing also include strategy and market strategy, and segmentation and sizing, and how are we going to reach different people? Or is marketing the tactical engine that's cranking out social and events and demand gen, et cetera? Again, you can have a department that's focused on one or the other or both. You just need to know what it is you're looking for, because there's nothing worse than having a tactical head of marketing that you're expecting to be strategic, or a strategic head of marketing that you're expecting to be tactical without staffing under the person the right way.
There's a section written by your chief people officer who wrote about how the head of HR has evolved. I would think this position may be the second most important position after the CEO. What do you look for when hiring for that position? And what's the most important thing that the leader of HR could do to enhance the competitive position of the company?
It's an incredibly important function if you care about people and talent. And most businesses today can't afford not to care about people and talent. So, this is a function that I think people take a lot more seriously than they used to. I certainly do. I think it's a very strategic function. And, I think that in terms of a few things you can screen for or make sure that you're managing to in that function, one is that the person has a philosophy about building teams, not filling jobs, right? And really understanding, like, what's the mix of skills you're looking for? How do people need to fit together in the organization, especially in the early days? I think the second thing that you want is an orientation around coaching and around growth and development, as opposed to an orientation around transactions and making sure that benefits and payroll work well. And then finally, I think probably the single thing that I found most impactful with the HR function in terms of helping scale an organization is when the head of HR understands that their job isn't just to be a steward of the culture alongside you, although it is, but when they understand that their job is to weave the culture into all of the employee lifecycle touch points, so that the organization itself is the steward of its own culture. So what do I mean by that? If you're a strong values-driven organization, you should be recruiting against those values, interviewing against those values, onboarding people with training about the values and what they mean in your organization. You should be firing people if they're not holding to the values. You should be doing performance management against the values, compensation against the values. If you have a head of HR that gets that, and that is, they believe, weaving your culture into business process all over the place, you will build a scalable culture.
Interesting. So they have to think like the CEO.
They do.
Yeah. A question from the audience. How essential is an independent audit defensible 409A valuation for a startup?
I think it's pretty important. I don't think you have to do them quarterly, which you do when you get bigger. But I think once you're out of the founder stock stage, at least knocking out one per year is pretty important around issuing options. I mean, at the end of the day, there are two things that can happen if you are giving options out below fair market value. One is the employee can have a tax problem, and the other is that the company can have a tax problem. And you don't want to find out as you're getting acquired or going public that you have what they call a cheap stock issue. 409As are not required. What's required is that the board uses reasonable care to make a judgment about what fair market value is. if you're not going to get a 409A, at least document how you're arriving at what fair market value is, whether you're using comps or discounting for liquidity. I mean, look at a 409A and follow their methodology. But, if you're using Carta, for example, I think 409As are a couple $1,000, and, it's probably worth getting at least one a year to cover yourself.
Kathy Haley, your chief people officer, wrote that every person you hire in the beginning has an outsized impact on the culture. And you talked a little bit about this earlier, but what's your feel about this, and how do you screen that their outsized personality doesn't cripple or hurt the culture?
It's just a lot. I mean, it's just a lot of numbers. You have 5 people in the company, you hire a 6th person, they're 16% of the workforce. And they do have an outsized impact on culture. You do have to interview against your values. Even if you don't have well-documented values yet, even if they're not up on the wall and everyone's agreed to what they are, as the founder, what you care about. And you've got to interview against those things. And, I think look, you can have a philosophy that is 1 strike and you're out, or 2 strikes and you're out, or 3 strikes and you're out. You can have a philosophy of coaching people or not coaching people. But ultimately, if you have a bad values fit and a bad culture fit, it can be a disaster for your organization. And the faster you move those people out, the better.
Hence why you see sometimes CEOs get fired 30 days into their jobs, not realizing that they would be such a bad cultural fit, right?
Right. I mean, that's a really clear, like the analogy I always use, lots of people use is it's doing an organ transplant, right? Sometimes the body rejects the organ, and sometimes a company rejects a new hire or a new executive.
Did you find that some of the people you started with hit, the ceiling ability, they hit the ceiling and based on the size of your organization, or didn't fit into the mature organization? Or how do you know when to make that change?
Yeah, it absolutely happens. I remember very vividly a year or so into the return path journey, I think we had 25 people in the company, and one of our engineers quit, and he said he was quitting because we had become too corporate. And I sort of laughed because, like, we weren't corporate. We were a 25-person company. We were a startup. We weren't corporate. But what he said was, well, I remember in the early days, we all used to sit around together and all make the decisions together. And now we don't anymore. Now you have a leadership team. And it's kind of an interesting frame. I got that from his perspective. It actually wasn't true. It was never the case that all people in the company made all decisions all the time, but it was feeling different to him. And he didn't like that feeling. And he self-selected out. And I think a lot of people will self-select out if they're more comfortable at earlier stages. But having that eye as you're doing whatever form of feedback or review process you have of, is the right person in the right role for the right stage of the company is key.
What did you look for did you have a board of directors or an advisory board?
Yeah, no, I had a world-class board at Return Path, and I'm building what I believe and hope is a world-class board here at Bolster as well.
So what did you look for when you were building those boards?
So not to plug the next book, but I'm actually working on startup boards, which will be out in the middle of 2022 next year. And I'm doing that in collaboration with Brad Feld and Mahendra Ramsangani, who are our 2 VCs that wrote an early edition of that book 7 or 8 years ago. So we're doing a new one that's going to address a lot of these topics in detail. But I'll tell you just real quickly, because I know we're getting to the end of our time here.
Yeah.
I am a big believer in having a board, in taking your board seriously from day one, in having independent directors on your board on day one. And my sort of rule of ones around board is that there should only be one founder on the board, and that you should have one independent director for every one investor on the board. So if you got a 3-person board, it's founder, investor, independent. You can have a 3-person board with founder and 2 independents if you haven't taken on big money yet. If you have a 5-person board, founder, 2 independents, 2 investors. I think that ratio is really important to having a healthy board.
When you said about, what if you have a founder and you own 51% and they own 49%? Do they get on the board or they don't get on the board?
Invite them to every board meeting, right?
As an observer, but they're not on the board itself.
Yeah, I mean, have them come to every board meeting. Have them you have 100% of that person's mind share on your company. And the board is a rare opportunity to get other very senior, experienced minds on your company. And taking up a board seat with someone else on the management team is not ideal. There are times where you have to do it. I get that. But I don't think it's ideal. And if you're worried about governance, if that person says, hey, I own 49% of the company, set some stuff up in the corporate documents that that person has to agree to decisions about X, Y, and Z. They don't actually have to have a board seat. Use those board seats sparingly and use them to bring in new advisory talent that can really help you add to the mix.
Well, you have to have that conversation at the very beginning, right? Because that could be a showstopper
At the very beginning.
And putting a partner in a partnership, getting together for sure.
Yeah.
And finding those right board members, because I've seen so many companies where they pick people that they can control, and that never turns out well for them either in the long run.
No, I mean, you want great independence, and the reality in the early stages of a business is if you put someone on the board representing common shareholders, you can probably take them off the board if they're not doing the right thing. That gets harder once you have preferred shareholders and maybe independents are subject to both people agreeing on them, both parties agreeing with them. But having an independent director who is actually an independent thinker, who has the best interests of all the shareholders of the company in mind, and who can contribute strategically to you, whether it's by opening doors, helping you, in product, helping you in selling, helping you in mentoring you, is just a great opportunity.
Last question. What has changed in running a company because of the pandemic?
I mean, I think it's too soon to tell in the long run. You and I were talking about this before we started today, Mark. Yeah. I think sort of the balance of humanity and efficiency, meaning the balance of being in an office with people and spending time with people as people, and putting your head down and working at home and just doing 15-minute Zoom meetings. That balance is tricky now, and I think I think people have to, if you are in a situation where everyone's remote or you're doing some form of hybrid, really being intentional about that balance of humanity and efficiency. I think that that's sort of the biggest thing that's changed. And just the one thing I advise CEOs on a lot around this topic is, if you are remote first culture or a mostly remote culture, pay attention to your most junior employees. Pay attention to the introverts. Pay attention to women and people of color who might not have as loud a voice, who probably in an office environment might have your attention because you see them, might learn by osmosis, by walking around, by overhearing conversations. And when those things go away because you're all on Zoom in 15-minute increments, pay attention to those people.
I want to thank you so much for taking the time, and we got to have you back when the next book comes out.
You got a deal. Nice to talk to you, Mark.
Everybody enjoy your weekend, and look forward to seeing how Bolster matures.
Me too.
Have a great day, everybody, and a good, safe weekend.